Expansionary monetary policy this time, and I'm going to answer this question of does expansionary monetary policy really stimulate the economy and stimulate investment? Okay, so let's start with the definition. Keywords. Okay, what is the expansionary monetary policy? It's the use of monetary policy tools to increase the money supply, lower interest rates, and stimulate a higher level of economic activity. So, in other words, it's a policy that is often implemented to combat recession when the economy is very slow. People are not buying stuff. People are not producing at all. Central bank implement this policy of lowering interest rates, so it becomes cheaper to borrow money. So, who's gonna borrow money when money is cheap to borrow? Probably firms and maybe some household when it comes to buying houses as well as cars and education such as university and other things. So that increases consumption and investment, which can stimulate the economy. And we have two concepts that I'm going to explain more in detail later. Well, I should explain what federal fund rate is. It's the interest rate determined in the private market for overnight loans of reserves among banks. Okay, so it's basically the interest rate that the bank needs to pay when they borrow money from other banks. Okay, sometimes they run out of excess reserve to extend loans to other like to banks and individuals, so they borrow from other banks and they have to return it the day after with that interest rate, which is called federal fund rate. And Fed, which is central bank in the U.S., can influence federal fund rate. They don't control it fully, but they almost control it by influencing it very precisely. So how does expansionary monetary policy lead to more investment and economic growth? Let me explain that. Okay, so we know that Fed raises federal fund rate by using its policy tools such as open market purchase. That's the main thing that they use to take and implement an expansionary monetary policy. They buy a bunch of bonds that commercial banks are uh, hold. Okay, and when they buy it, of course, they pay it. And Federal Reserve, the central bank, can create money. So they create money and pay to those commercial banks. The commercial bank is gonna get a bunch of money, okay, in their bank reserve, so they have excess reserve available to extend, so they can extend loan to businesses, households, and other banks and things like that. Okay, so banks with a lot of excess reserve can extend loans to many businesses. So all I can actually draw supply and demand very quickly. Okay, so this is federal fund. Okay, federal fund market, and we have federal fund rate, and it's a supply shock. We have demand and supply, and this will be new supply because Federal Reserve purchase bonds, government bonds that those banks, commercial banks own. So they pay and they increase the federal fund available, so that lead to uh, lower federal fund rate. So it's cheaper to borrow, and when it's cheaper for commercial banks to borrow from other banks, it's gonna be really easy for them to extend loans, which also reduce interest rate on other loans, right? Whether if it's car loans, education, well, university loans for universities or loans for businesses or anything. Okay, so lower interest rate means it's cheaper to borrow money, and that increase investment in theory. Okay, in theory, because it's cheaper to borrow money, so the firms can use it to make an investment goods, which is often structures, equipments, or inventories. Okay, and that can drive up aggregate demand, pushing the economy back to full employment level, especially if they're in recession already. So let me draw that very quickly. Uh, what it means by full employment level of output is the GDP level that is utilizing all resources available in the economy without leaving any resources left idle. Okay, we have AS curve here and 80 somewhere, but before that, let me just write real GDP. Okay, real output, and we have price level. And full employment level of output is probably around here, before economy experience its full capacity, like, you know, the point where they can no longer increase any output. That will be here. Right before that is full employment level of output. This is like productive, maximum productive capacity or something like that. And then let's say economy was kind of sluggish, people were not buying stuffs, so firms had to cut production. So way below unemployment full employment level of, but maybe unemployment rate is quite high, like 8% or 10%, then expansionary monetary policy in theory increase AD because firms buy a lot of things, which stimulate the production. When buys a lot of equipments, those firms that produce those equipments need to expand their production, hiring more people, and those people get income, and probably they will spend some of it. That also increase consumer spending. That is multiplier effect. So it increases AD in theory, which push the economy back to a full employment level of output. Unemployment can fall potentially. That, at least that's what they want to, and GDP can also grow, of course. That's what they want to do. Okay, and there's also one more thing that the maybe we can expect, or we hope that expansionary monetary policy will lead to, which is increased investment leading to expansion of the productive capacity of the economy in the long run. So that would be a change in supply rather than demand. This is a short-term economic growth, right? The one that I just explained. However, buying new structures, new equipment such as robots, computers, new very efficient, effective factories, or things like that, right? Investing in those things can increase the productive capacity in the long run, which can shift the AS aggregate supply like this. So maybe we can have long-term economic growth, which is amazing, which often lead to which often people increase people's income, what people can consume, what the level of production, without necessarily leading to inflation. That's what people want, and maybe by increasing a very effective private investment, that's what they can get. Okay, so there are like two things. Okay, they maybe well they can they want to achieve short-term economic growth uh, from this expansionary monetary policy, but long-term economic growth could potentially be achieved by expansionary monetary policy too, by cutting interest rate and stimulating investment, and if that investment is actually effective in increasing productive capacity for each firm and for the economy itself. Okay, so what's the limitation of this approach? Okay, so interest rate is just one factor that influence investment level. Imagine, like, imagine you're running a business. Do you only look at interest rate and determine how much to borrow? Not really. There's so many other things that influence it, and one of the big thing is the sales, how well you're doing in terms of making and selling your goods. Are people buying your goods and services? If a lot of people are buying every year, maybe you want to invest, whether interest rate is high or low, right? So factor not related to interest rates, such as low business confidence due to low sale growth, may limit investment. Okay, or even if interest rate is very low due to expansionary monetary policy. So the effect also depends on the type of investment too. So okay, before we get into that, let me just draw that very quickly. So if we draw this, we can actually draw a loanable fund market. Okay, loanable fund market, and we have supplier in the loanable fund and demander in the loanable fund, which is maybe firms and other borrowers. Okay, and then we have suppliers, which is, well, savers, investors, savers usually, and we have interest rate. Okay, so let's say that investment interest rate is uh, driven down because of the increase in supply due to the open market purchases, right? Then yeah, it looks like interest rate is supposed to go down, uh, and which actually increased the investment level from here to here. So people argue, yes, lower interest rate, of course, increased in the level of investment, which can lead to long-term economic growth too, as well as short-term economic growth, which is driving economy out of recession, something like that. However, if they do not have confidence, right? Maybe recession lead to loss of confidence for uh, firms. Maybe demand can also shift to the left. Okay, they don't want to borrow much, and this is non-price factor, meaning non-interest rate factor regarding the demand for loanable fund, which is like low business confidence and things like that, right? In that way, the new equilibrium, this will be new D and new S here. So it wouldn't, right? We can tell that it hasn't expansionary monetary policy hasn't really increased the investment level because business uh, confidence is very low, especially when recession is happening. And when is expansionary policy often implemented? When recession is happening, right? When economic growth is very stagnant or even negative. So maybe that can be the problem, and we call that accelerator principle. Okay, the idea that high GDP growth leads to increasing investment and low or negative GDP growth leads to declining investment, which is a very important factor. Of course, it's not denying the importance of interest rate in influencing the investment level, but it is saying that there are other important factors such as sale growth, which can be represented by GDP growth in macro scale. Okay, and we also have to acknowledge that it also really depends on type of investment. It depends on sector, it depends on which industry, things like that, right? The confidence level may be very different, and maybe some areas, some sectors, some industry is not really losing its confidence by recession. For example, let's say, I don't know, I'm just assuming, I haven't really checked, but I'm assuming that, for example, some industries are really not volatile, like they're really insensitive to recession. For example, healthcare related, or medical care, medicine related, right? Or because people buy those products, goods products, even when economy is not doing well, even when their income is not rising, or when they get unemployed, right? So they're really um, strong, right? They don't fluctuate so much. In that way, maybe even in the time of recession, they haven't lost much confidence, so they increase their investment level if interest rate is lower than before due to expansionary monetary policy, right? It really depends on sector, and also we also have to acknowledge that type of investment such as residential investment that I have written here is also very sensitive to low interest rate, right? Uh, well, one of the big reasons is that residential investment, it's basically purchase of home, right? And a lot of household do that. All it's considered investment. When we calculate it, it doesn't feel like it's investment. It feels like it's more like a consumer spending, but it's technically categorized as investment. Okay, so it's called residential investment. And when you want to buy a house, do you care about GDP growth, or do you care about how much sales that firms are having? Not really, right? Well, you could care about it, but not as much as how much business cares about it in terms of, well, when they borrow money. When business borrow money, they really need to look at whether their sales is looking great or not. But when it comes to residential investment, it's something quite similar to consumer spending. You don't really care about sales or blah, blah, because it's irrelevant. Like, you buy houses because you want to have a good life there. So the price of borrowing money is far more important than non-price factors, non-interest rate factors, right? So it can be very less sensitive to other economic conditions, but it can be very sensitive to interest payment, right? And another reason why they can be the purchase of house can be very sensitive to the to interest rate is that it's often long-term loan. Okay, when you get mortgage, when you take out mortgage and buy house, you have to pay back over like 30 years or something. So even a small difference in interest rate can make a significant difference in total amount of money that you pay to gain that house over 30 years, right? So that's another problem. So maybe if interest rate is low, a lot of people are going to be like, okay, this is the best chance to borrow money, take out mortgage loans, and buy a house. A lot of people say that, and some speculators could say that too. Speculators who want to buy a house and wait until the price goes up and sell it. A lot of these people think that way. So residential investment can actually rise quite significantly as a result of expansionary monetary policy, which could be a bit different from what they're probably intending to do in terms of long-term economic growth. Because again, like, firms, businesses investing in their equipments like machines and computers, or structures such as factories, can actually lead to overall economic long-term growth by expanding productive capacity. But maybe, like, building more houses could lead to economic growth, but not necessarily. It's not, first of all, it's not necessarily businesses, right? And also speculation is obviously not what they want by taking expansionary monetary approach. Okay, let's look at case studies, right? I have a lot of good case studies here. So let's look at expansionary monetary policy which was taken after dot-com, well, which was taken to combat dot-com recession. Okay, so let's start with the context. U.S. economy got into recession after dot-com bubble. I think it was like a stock market bubble. A lot of people had a very good confidence about, IT. Sectors, farms, businesses doing well in the long term, making a lot of profit. A lot of people expected that. A lot of people bought stocks of these random, like, I think IT related businesses, and that led to speculation. And any speculated bubble cannot last forever. The price of those stock went down quite significantly. A lot of people lost confidence. Uh, so the economy got into recession. GDP declined by 0.3%. Not horrible, but still painful. And the peak unemployment was also 6.3%. Not the highest, not one of the highest that the U.S. experienced, but it was still bad. So the economy was in recession. Okay, and then Fed, Central Bank of the U.S. was like, we have to address this. Okay, we have to address this by making borrowing money cheaper and easier. Okay, so federal fund rate was driven down by Fed down to 1%. Let's actually look at that. Federal fund. Okay, see, very dramatic decline in dramatic cut. Okay, significant cut in federal fund rate from 2000. Uh, in this period, very low, record low interest rate, which was hoping to stimulate investment, business investment. Uh, this is different. Okay, so that was the intention. Okay, however, business investment did not recover until late 2003. Okay, it was still stagnant due to their about pessimism about their sales, as well as uncertainty after 9/11. So they experienced a very harsh recession, and they were not really happy about their future. They were not confident about future. So when they're not confident, even when borrowing money, taking out loan is easy and cheaper, they wouldn't necessarily make that decision so drastically. So if you look at net domestic investment level in the United States of America, um, after experiencing a significant decline in this dot-com recession, uh, see, it didn't recover so fast. It was still stagnant until 2003. So that was the case. Okay, so not always very sensitive. Investment isn't necessarily always sensitive to interest rate, uh, especially when it comes to expansionary one. Even if it's cheap, if they don't have confidence, they're not gonna borrow to buy a bunch of equipments, machines, and structures that is not gonna uh, help them much, right? Well, at least that's what they're thinking. They're thinking that it's not gonna help them much when sales is already very slow or stagnant. Okay, so that was happening. Also, another reason why investment didn't grow much is uncertainty regarding 9/11. Okay, so those factors, non-price factor, non-interest factors, seem to be more dominant and more important for business this decision making in this period. Yet residential investment, which as I said, is very sensitive to interest rate and insensitive to business confidence, I would say, rose steadily during this period, boosting the overall economy. Okay, so residential investment was increasing. It's not maybe type of investment that we necessarily want in terms of long-term economic growth. Maybe not. Well, I would say it's not as effective in expanding productive capacity than making more good factories and investing in new machines, things like that. However, it still has the similar effect or same effects in terms of increasing the aggregate demand and uh, pulling economy out of recession, accelerating short-term economic growth. It still has the same effect in terms of that, whether if it's a bunch of businesses ordering new equipments or machines, or ordinary households and speculators ordering constructions of bunch of houses, right? Constructions of houses still create jobs, create income, is still a production. So those people who receive those incomes will spend. It can lead to short-term economic growth like that. Okay, so investment was growing in terms of residential investment. Non-residential investment wasn't rising much. Okay, so this allowed Fed to gradually raise federal fund rate again. We can look at unemployment rate. Wait, where's okay? Let me go back to unemployment rate. Okay, So unemployment was recovering after dot-com bubble, something like this, which could be an evidence that expansionary monetary policy was working, although it wasn't stimulating business investment much, but it was stimulating some other type of investment. So it was still effective in maybe pushing economy out of recession. And Federal Reserve was raising interest rate uh, quite like gradually, which is an evidence that economy was booming a bit. So they were like, okay, maybe we don't have to keep the extremely low interest rate anymore. So maybe it was effective to a certain extent. However, type of investment was residential investment, and it led to speculative bubble. Okay, even the gradual rate increase federal fund rate increase couldn't prevent the speculative bubble. Okay, so expansionary monetary policy to combat Great Recession in the U.S. So the United States experienced Great Recession, catastrophic recession in the history of that country, after the crash in housing market, which was indirectly caused by expansionary monetary policy in this period that I just explained again. So federal fund rate went nearly to zero. Okay, even lower than what they put to address dot-com bubble. Uh, it's nearly 0%. Okay, it's extremely cheap to borrow money, but did the economy recover very rapidly as a result of very cheap cheap loanable fund? Well, not really. The recovery after the Great Recession is famously very slow and stagnant, and unemployment rate remained very high until like 2014, 15, at least like second Obama's administration. It was famously very slow recovery, but people can argue that it doesn't mean the monetary policy wasn't working. Maybe if without expansionary monetary policy, it could be way worse. It could have looked like Great Depression that happened from 1929. We don't fully know this. Okay, we can't hypothetically create a world without Fed taking expansionary monetary approach to combat Great Recession. All we know is that they did implement expansionary monetary policy, and it did lead to economic growth and recovery, although it was slow. Okay, speculative bubble in Japan. This is another case study which kind of resembles the expansionary monetary policy after dot-com recession. Okay, so Japan's export-oriented economic growth slowed due to strong yen. It's called Plaza Accord, which kind of decreased the value of which increased the value of Japanese yen. Japan's economy very was relying on export. Okay, export was making a lot of revenues for Japan, and that decreased a bit, and that wasn't looking great. So the Central Bank of Japan took an expansionary monetary policy to stimulate investment. But investment maybe did rise to a certain extent, but it wasn't much. And the other things actually was stimulated, which was again speculation in assets and land. Okay, in assets such as land and stocks. So people borrow money and bought land, because land is not as well, like investment in lands, purchase of land wasn't influenced as much by business confidence compared to other type of investment. And also a lot of people borrow money to buy stocks as well as land, and that drove the speculative bubble further, which did result in its eventual crash and horrible stagnant economy for like almost for 30 years. So my conclusion is that it's sometimes uncertain whether expansionary monetary policy is really effective in increasing investment. We have some evidence that it can increase the aggregate demand and stimulate the economy and push economy out of recession, whether if it's slow or fast. We have some evidence that it sometimes works. But what's more complicated is that type of investment that rise as a result of low interest rate could be problematic, such as, well, not problematic, but which sometimes is not ideal, because it's not a type of investment that actually expanded productive capacity of the economy in long run as much, right? Such as the speculation that we saw, speculation in assets such as land, real estate, homes. Not the best thing that we want to see. What we want to see is businesses be using its a lot of its smart ideas, and think a lot about their future, what is actually very good for their businesses, and buy a bunch of equipments and structures that help their production in the long run, so they can provide a lot to consumers, right? Ideally, that's what we want, but that's not necessarily what always happens when monetary policy is expansionary. Thank you.